Okay, hi all. So last time we decided to do more exercises about the last chapter. For that, I prepared some questions and I suggest you to solve them by yourselves first, then try to look at the answers. Okay. So John has decided to start his own lawn moving business. To purchase the movers and the trailer to transport the movers, John withdrew $1,000 from his saving accounts, which was earning 3% interest, and borrowed an additional 2,000 from the bank at an interest rate of 7%. Okay. What is the John's annual opportunity cost of financial capital? Okay, so 1,000 times 3% plus 2,000 times 7% are the opportunity costs. Okay, so due to this business, the withdrawing the monies lead to that. Okay, so this is 170. So this is option C. Okay, Samantha has been working for a law firm and earning an annual salary of $8,000, and she decides to open her own practice. Her annual expenses will include $15 for office rent, $3,000 for equipment rental, $1,000 for supplies, $1,200 for utilities, $35,000 salary for a secretary, and Samantha will cover her startup expenses by cashing in a 20,000 certificate of deposit on which she was earning annual interest of 500. Okay, so implicit costs are the opportunity cost. Okay, first to start this business, she gave up her previous job, which was bringing her $70,000 plus, and in order to cover her expenses, she cash by cashing in a 20,000 certificate of deposit, and this was his annual interest of 500. Okay, so these are the opportunity cost. Okay, annual accounting cost, the cost that you can see. Okay, so the cost that you can see are what? Annual expenses will include 15,000 for office rent, 3,000 for equipment rental, 1,000 for supplies, 1,200 for utilities, 35,000 for salary for a bookkeeper. Okay, 15,000, 35,000 salary of the bookkeeper, 3,000 for rental, 1,000 for supplies, 1,200 for the utilities. Okay, so this is 50, 53, 54, 55, 200. Okay, so this is option A. Okay, and then Samantha's annual economic cost will be what? The sum of those two is gonna give you economic cost, which is $135,700. According to Samantha's accountant, which of the following revenue totals will yield her business 50,000 in profits? Okay, so you are gonna consider the accounting cost. So accounting cost was 55,200 plus 50,000 is this. Okay, if this person Samantha has revenue of this much, then she can obtain 50,000 accounting profit. Okay, economic profit. In order to obtain the economic profit of 50,000, what should be the revenue? So economic cost is 135,700 and 50,000 profit. So in order to obtain 50,000 profit, revenue should be this much. Okay. So scenario 2, you are the owner and only employee of a company that sets odds for sporting events. Last year, you earned a total revenue of $100,000. Your cost for rent and supplies were $50,000. To start this business, you invested an amount of your own capital that could pay you a return of $20,000 a year. During the year, your economic costs were, so your implicit cost plus your explicit cost, okay, which is 50,000, okay. A yearly normal rate of return for your company is what? Total revenue is a yearly normal rate of return for your company is 20,000. Okay, so this is the amount that leave you indifferent between doing this business and not. Okay, so remember, you invested an amount your own capital that could pay you a return of 20,000. Okay, in order to stay in this business, you should earn, your profit should be above $20,000. Okay, a yearly normal rate of return for your company is 20,000. Your accounting profit last year, okay, total revenue $100,000. Okay, and explicit costs were 50,000. Okay, so accounting profit is 50,000. Your economic costs were 100 minus 100,000 minus the economic cost. Economic cost is 50,000 plus 20,000. Okay, 70,000 minus 70,000. Okay, 30,000 is the economic profit. Okay, now true false questions. If the marginal cost of producing 10th unit of output is 2.5, if the average total cost of producing the 10th unit of output is $3, then at 10 units of output, average total cost is rising. Okay, so let's draw the cost. Okay, so this is Q, this is AC, MC. Okay, so this is the AC. What we said, marginal cost will pass minimum of AC. Okay, so in here we have 10th unit of average cost is above the marginal cost. Okay, so let's say this is 3, this is 2.5. Then what we can say about average total cost? Average total cost is decreasing in this part, right? Until they intersect, until average cost and marginal cost are the same, okay, average cost is decreasing. Afterwards, average cost is increasing. False. Okay, average cost is decreasing. Okay, if the marginal cost of producing 10th unit of output is 3 and average total cost of producing 10th unit is 2, now we are in the other side. Okay, marginal cost is above the average cost, then average total cost is rising. True. Okay, now variable cost equal fixed cost when nothing is produced. No. Variable cost is changing. False. Variable cost is changing with Q. Variable cost is 0 when nothing is produced. Okay. You can also say that total cost equal to fixed cost when nothing is produced, because variable cost is 0 if Q is 0. Okay. Average variable cost is equal to total variable cost divided by quantity of output. No. Yeah. Average variable cost is equal to total variable cost divided by the quantity of output. Okay, so AVC equal to variable cost divided by Q. True. The marginal cost curve intersects average total cost curve at the minimum of marginal cost curve. No, at the minimum of average total cost curve. False. They intersect at the minimum of average total cost curve. Okay, if long run average total cost is rising, then the firm is experiencing economies of scale. No, then it is experiencing diseconomies of scale, right? If the average cost is rising as Q rises, then it means that there is a diseconomies of scale. Fixed costs are those costs that remains fixed no matter how long the time horizon. False. What we said, fixed costs are there in the short run. In the long run, there is no fixed cost. There is no fixed costs. Okay. Which of the following would be an example of implicit cost? Foregone investment opportunities, wages of the workers, raw material costs. This is I only, right? So foregone investment opportunities is the implicit cost. Opportunity costs are implicit cost. Which of the following is an example of an implicit cost? The owner of a firm foregoing an opportunity to earn a large salary working for a Wall Street brokerage firm, yes. Interest paid on a firm's debt, okay, and rent paid by the firm to lease office space. No, this is firm's debt's interest rate. So this is explicit cost again. This is first one